This is what we've already seen. Now, a lot of expectations that have come in from brokerage houses as well. What have you picked up?
Well, multiple brokerage houses have come out with the report, but top 5 among them, firstly starting off with UBS. Now, they are expecting, or they're saying that the impact of budget on markets would be very muted. They're not expecting much of a growth coming in from the capex and consumption, given that the government wants to contain their fiscal deficit at around 4.5% of the GDP in FY26. They're saying that the capex, if it is less than or around 11 lakh crore rupees, this will definitely be negative for core infra companies like L&T and capital goods company as well. When it comes to Macquarie, now they are saying that there won't be any change in gold tax this time, like something that we had seen in the last budget. They are expecting a mid to single digit hike in cigarette taxes. For the past 3 years, we have not seen a major hike when it comes to cigarette taxes, so they're expecting a mid to single digit tax hike this time. And they're also saying that there could be some measures to address the dumping that we have been seeing from China. So some safeguard duties or import duties could come in from the budget this time. Now, when it comes to Morgan Stanley, they're expecting the government to budget for higher capital expenditure growth this time, but the focus would be more on execution and implementation. This was something that was lacking in FY25, so that focus would increase in FY26 as per Morgan Stanley. They're also expecting some rationalizations to come in when it comes to direct taxes and some sector-specific incentives to come in from the government side. Now, they're all continue to remain overweight when it comes to financials, consumer discretionary, industrials and technology, while they're underweight on all the other sectors in the market. Now, when it comes to Jefferies, they are saying that less than 15% capex growth would definitely be negative for core infra companies like L&T and EPC contractors as well. So, more than 15% growth is only something that could cheer the market, at least the capital goods stocks as per Jefferies. They're expecting some welfare measures to come in. They're expecting expansion in the PLI schemes, and they're also expecting a capital gain tax hike that could come in this budget as well. But they're also advising their investors that if there is a dip post the budget, then that should be a buying opportunity for in the Indian markets. And when it comes to JP Morgan, they are saying that the government spending would be limited, given the fact that they need to maintain the lower fiscal deficit target, and also the indirect tax collection was lower this financial year. They're expecting government to prioritize on infrastructure, public investment, and some support for consumption also should be given by the government in this budget. Now, the key focus sector areas would be railways, housing, urban infrastructure and defense, and the brokerage continues to remain overweight on financials, consumer staples, healthcare, real estate and industrials.